Today we'll be talking about strong highs versus weak highs. Not every strong high is equally important. Some highs are strong, others are weak. And knowing the difference will help you understand trading. So that's what we're about to do in this video. So let's break it down. First, we have the strong highs, and it's a swing high that the market has failed to break despite multiple attempts and sorry, which can cause significant rejection. So when you see a level where there's been multiple tests and tests and tests and price does not break through it, it comes to that area. There was one here, you can see there was here, there was here, there was here. It got tested 3 times around that level, but it didn't break through it until at this point. Those are very strong highs. You also see lows where price will get very close to those areas and then not trigger them. You can see here, 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 here. Price tested that area 4 good times without breaking through it until here. So those are examples of how of our strong highs, and it usually represents areas where sellers successfully defend the price, so it's not going to break through. It's just going to keep testing and testing, sell off, buys back to that level, sells off again. And because of this, it's very important, it becomes a very important resistance area. And then we have the weak highs. It's the swing high that appears likely to be broken. It often forms when buyers remain in control and continues creating bullish market structure. Weak highs frequently become target for liquidity before price continue moving upwards, which is usually the already broken swing highs or swing lows. But if price bounces off a swing high or a swing low severally, you know it's a very strong area. But if it doesn't, it just goes towards that swing high or swing low, it breaks past it, price usually comes back to retest it before it continue buying or selling, depending on the area. For this, for instance, let's say we have this and then price comes here and comes here and comes here and we test this point 3 good times without being able to break this. This is a strong area, and then it finally breaks it and then it reverses back into it. It reverses back into that area before it continued, and then it bounces off at this level. So that's just to show you that this was a strong resistance area. Price went, and you can see that even when it broke out through this bullish candle, it retested it immediately before it continued, and then finally came back to retest this one. So those are just patterns in the chart that shows you where you have weak highs, strong highs, and usually the weak highs will get broken immediately and then retested, and then price continues, and the strong ones will just price will keep bouncing off it over and over and over again, and then eventually breaks past it. It does break past it, but it's going to bounce over it a couple times, 3-4 times. Mostly twice is fair, but 3-4 times, sometimes more, and that's just typically it. There's not so much to identify in it, and this matters because it helps you anticipate where price reacts to and where liquidity could be resting. In areas where we have strong highs, liquidity could be resting in those areas a lot. So price is likely to come back to that area after it breaks out of it to clear out the liquidity. So, which is why it's important for you to be able to identify these levels and trade them right. So many beginners actually assume that every resistance level would hold. In reality, some highs are simply waiting to be broken. So you have to learn how to distinguish between the strong and the weak, the strong and the weak high. Strong highs and weak highs are not just labels, they're a way to understand the balance between buyers and sellers. The more charts you study, the easier it becomes to recognize the difference. So yeah, it's very important while trading, and these are very significant things for you to understand in the charts. That will be all on this video.